Hey team, it is Monday, September 16th. It is Fed week and getting a lot of questions from referral partners, from borrowers, and just people in general, family, friends, about what's going to happen here on Wednesday. So we're going to run through a little bit about what the Fed funds rate is, how that affects mortgage rates, typically what we're expecting this week, and just kind of how all that stuff works, and where we're going to go, hopefully by Wednesday afternoon, about 2:30. So first we'll talk about what the Fed funds rate is. So the Federal Reserve is going to make their decision on interest rates and the Fed funds rate that is going to come on Wednesday afternoon of this week on the 18th. So the Fed funds rate is the interest rate that banks borrow from other banks. Okay, this is an overnight interest rate. It's going to be very low. It's a very short amount of time, but it is very large dollar amounts that we're working with. Okay, so the Federal Reserve has two main mandates really that are going to be: one, control inflation, and also keep the economy growing. Okay, so the way that the Fed controls inflation and they also spur the economy or slow the economy is by raising or lowering the Fed funds rate. Okay, so when they raise the Fed funds rate, it's going to slow the economy, right? And in turn, that is going to slow down inflation. That's going to shrink growth. Okay, when they cut rates, that spurs economic growth, and that's typically going to raise inflation. And they have to play this balancing act of raising and lowering rates to have the economy grow at a steady pace while keeping inflation at a steady pace. And they always do this back and forth, up and down, with the Fed funds rate and inflation, and moving the economy one way or the other. Okay, so typically when they're cutting and raising rates, that's their goal, is to play that balancing act of what's happening with the markets as far as the economic growth and controlling inflation. Now, how that applies to mortgages is a completely different thing. Okay, so historically speaking, when the Fed raises the short-term rates, that is good for mortgage bonds, mortgage-backed securities, slows inflation, interest rates get better. It's an opposite reaction to what the Fed's doing. So what's weird or interesting about this Wednesday is that the Fed is expected to cut rates for short term, which normally and historically would raise interest rates. But we're not expecting that this time around. Okay, it's not a direct this happens, that happens. That's not how this works. But what we are expecting is for them to cut 25 to 50 basis points from the Fed funds rate on Wednesday. And the commentary that's coming with that afterwards is what we're looking for. Okay, what they say about the economy, about inflation, and where they're headed or what their thoughts are is going to dictate what we expect to happen with the stock market, with the economy, with inflation. And if all of those things line up to what we expect to happen and what we're seeing in reports, and all of these reports are lags, or projections and all of that. So it's a little bit of a, crystal ball action, but what we're expecting is for them to say the information that the reports are confirming, for the economy to be at a certain level, inflation to be under control, all of these things over time, and that's going to be good for mortgage rates. If that all occurs, then yes, we could see better interest rates on Wednesday and continuing forward, which is the expectation. Now, how much? That's the question. We don't know. We may get 0.25%, we may get 0.5% better on Wednesday, we may get 1/8% better on Wednesday, or 0 on Wednesday, and it might get better Thursday or Friday. We just don't know what that's going to happen or when that's going to happen, because it is not a direct 0.25% cut. We get 0.25 on interest rates, 0.5%. That's not how that works. Okay, so ideally, in a perfect world, we've all been waiting couple of years for this, for interest rates to come down, mortgage rates to come down. We've been waiting for it. The world's been waiting for it. Everybody, home buyers, sellers, everybody. And hopefully that is going to happen on Wednesday and continue on as expected. But it's not as easy as they're cutting by 1/4 to 1/2. Okay, so I hope that helps with your thoughts and what's happening. A little bit of clarification maybe kind of muddies the water, I think, for most people, that wait a minute, it's not just if they cut rates, rates go down. You will see your credit card interest rates go down, Your car loans will be cheaper. Things like that will be cheaper come Wednesday afternoon, maybe Thursday, but those things will come down. But mortgage rates is a little bit more nuanced to it because of the indirect connection to that. The second part of what we've been looking at and what happened in September has to do with the Fed's balance sheet, which they're not supposed to have. Now, when we're talking about this balance sheet that the Fed is not supposed to have, but they do, and they have trillions of dollars sitting in there, the challenge with that is because they're not supposed to have it. So rewind all the way back to our, pick a name for it. They think that they named it the Great Recession because they were too afraid to call it a depression, but everybody has their own opinion. So when that happened, the Federal Reserve realized that they could do something to affect mortgage rates directly. It's not the interest rate, but buying and selling, we get into the law of supply and demand, buying and selling mortgage-backed securities and treasuries. And that's what they did. That's how they dropped interest rates down into the 4s. Then they reinvested what they were making on that original investment and bought more, and that brought interest rates down into the 3s. And continue into COVID, they did it some more, and that brought interest rates down into the 2s. It's all artificial. The 2, 3, 4% interest rates, those never should have been there. The standard mortgage rate, if you look at, an average, I think right now it might even be at 60 years. I know it's over 50, I believe, for right now of average is going to be between 6 and 7%. And that's even when you take into account interest rates being at 18% at one point and 2% at another, that the average is still going to be 6 to 7. So we're in the normal range right now, which is a good thing. But of course, we've been spoiled for, 13, 14 years, whatever that number is, on when those interest rates actually came down. And we've been seeing 2, 3, 4% or, in those ranges. So when the Fed bought those mortgage-backed securities and treasuries and continued building that balance sheet, they eventually have to get out of that. And in September of 21 is when they were announcing that these things were going to happen, that they were going to start to let those roll off and get them off the balance sheet. And that was the catalyst for interest rates to actually start going up when we talk about mortgage rates. As I said before, typically when the Fed raises the Fed funds rate, that reduces inflation. And that's what they had to do to bring inflation down, to slow the economy, bring inflation down. Historically speaking, them raising rates should have brought interest rates down, but there was nowhere for them to go. They couldn't go to zero. So they also let the balance sheet start to roll off. When they announced that they were going to be doing that, supply and demand, now we have all this extra supply, well, now the price has to change. And that's what made interest rates go up in the mortgages, and it happened really, really fast because there was a ton of money sitting there, and it kind of freaked everybody out, I think. All of this money is now there, going to be flooding the market. Like, what do we need to do? We have to incentivize people to buy that, which means we have to pay higher returns, which means we have to charge higher interest rates. That's what we were seeing that makes this last rate cycle of them raising interest rates should have brought mortgage rates down, but it didn't because they couldn't go any lower. So because they were letting these things roll off, it also caused interest rates to go up. And that's where we find ourselves today, where we have a little bit of the opposite going on, where the Fed is supposed to cut, and we're expecting mortgage rates to also come down. Again, not because of the cut, and it's not a dollar for dollar or percentage to percentage of when and how much those interest rates are going to come down. That is all based on market conditions, the commentary afterwards, what they say. There's a lot that goes into it. So I hope that helps you guys. If you have any other questions, feel free to reach out to us. Happy to have a conversation with you about your individual situation or your client's situation, on interest rates and what we're doing. We have a plan for all of our clients on what we're doing here this week as well, and coming into the future. We have a bunch of people waiting to see what's going to happen, and then work on refinances, and people are waiting to put in offers on properties and lock rates. So a lot happening this week. So also please be patient with your loan officers. If you can't reach us, Wednesday, Thursday, Friday, we're probably in the middle of a few things because it is a big week. We've been waiting 2 years for this to happen, and it's all going to happen pretty close to at once. So it's going to be a very busy week for everybody. But if you need anything, feel free to call, text, email, whatever you need to do to get a hold of us. I hope you guys have a great one, and we will let you know how this all turns out towards the end of the week.